So dashboard, we are March 3rd, 2025, and let's review what happened on the market from, let's say, a numbers and charts perspective, which is my thing. So I'll go much slower, just for you to be able to see what I'm talking about. Let's remove this thing. Oops. Yes, I'm just trying to make it look better for you. So, so you see the major asset classes here. What can we note from that? So, another slight rebound after the massive rebound that we have before in the SPY. TLT slightly down, nothing major here as well. Treasuries, so interest rates were going down before the JOLTS report that I mentioned before. They contracted, we're going down. They went slightly up after the JOLTS reports for the reason I mentioned, but nothing really crazy there at this point. I think that the few things to note, and we'll see this in the activity in a couple of screens, is gold. That was down 2.2%. I mean, the correction of the gold is not what is exactly interesting here. What is interesting is that the rise in the 1 month volatility, specifically in relationship to the long-term volatility, is still rising. It's now the second highest volatility increase ratio, let's say activity ratio, in this across the major asset classes, which means this is where the activity is. So if you look at where the activity is, first is the equity market, then it's the US dollar market, in third come the gold market. It's not, it's pretty unusual to have gold and the US dollar being one of the most active, not in terms of volume dollar, but active compared to what it's usually like, which again shows that we are still in a kind of a crisis situation at this point. It's quite unusual. But if you look at gold, not only the activity measured by volatility is high and rising, the activity measured by the volume, which is less reliable, I would say, specifically because here I take the ETF, is also sharply increasing. So usually when you have, and again, this is not an investment advice, when you have that kind of heightened volatility, we are at turning points on the market, either a top, either a bottom, or this is when the bear and the bulls basically are fighting for where to go next. And we seem to be at least in a consolidation phase in gold. So it remains to be seen who will win this war on gold. If, let's say, trade tariffs are over, we don't need gold anymore, everything is fine, and then gold maybe go down. Or if the uncertainty remains on the market, and that could push gold higher. So we are in a situation where basically bull and bears are fighting, and we still need to check who will win this fight at this time. IBIT, gold, so Bitcoin ETFs didn't move much. The other important thing to note is the drop in oil. This week down 7.3%. Yes, about that, less than minus 7%. And I think it's important because oil used to be an indicator of geopolitical turmoil, specifically in the Middle East. Now we know that there is oil basically everywhere. The US finds oil, Venezuela has a lot of oil, so everyone basically has oil. So the geopolitical turmoil is, in my opinion, not much more a factor in the price of oil. But what is a factor is the global economy and the global trade. And what this drop, despite the market, the U.S. equity markets going up, what I believe the drop in oil means is that trade is slowing. The economy is slowing. We have talked about recession before in the US, and I believe this is a true indicator of what's happening at this time. So before going crazy long on the markets on this rebound, again, not only considering the current volatility of the market, I would be very cautious about going back to be crazy long. You always have to monitor the risk. The risk is your guide here. So we'll see that. So the historical volatility remains pretty high. The implied volatility has reduced. But I mean, it doesn't mean much, to be honest, in my opinion, because the implied volatility is very linked to the drawdown of the market, where the market is. So when we see the market rebounding, having the implied volatility in contracting is basically not a surprise. We often hear that implied volatility is forward-looking when historical volatility is backward-looking. I don't like this, denomination. Why? Because that implies that implied volatility has, let's say, a kind of predicting ability on the market when it actually does not. If you want to use forward for volatility, for implied volatility, I would say it's forward guessing, just like the market. It's an anticipation of what the market will be in a month, just like the S&P is an anticipation of what the economy of what the markets will be, in the futures. We are in market anticipation, so they are basically guessing all the time, not only what the situation will be, but what others will actually do. So that being said, so we have market, rebounding. So and implied volatility contracting when the historical volatility, even short term like 1 month, is still pretty high. I think I have it here in the next slide. So here this is gold. Actually, you see that gold has suffered a little bit this week. To be honest with you, I mean, it's not dramatic. It's normal that the market breathes. It doesn't always mean that that the market will revert or crash, although it's always a possibility. But when I'm checking that, and the reason why most funds and most CTAs are risk adjusting their position is because they want to control the risk globally of their portfolio. And again, it's an indicator very often on where the market is struggling to continue a trend and might be a reversion of the trend, which is why when you have high volatility at turning points, this totally makes sense to take money out of the table for the considered asset. So we see now oil, very same thing. What I said, I mean, oil has been looking ugly for years now. When we had contraction basically in the economy, in the market. We dropped, so we broke on the downside from very long term, multi years. This starts in 2020, at least 2022. Yes, I believe. So if you look at the last part of this chart, you very easily see that on Trump's election, we broke out on the upside from this wedge, from this triangle, on the news that Trump would be better for the economy, that would stimulate the economy. But these expectations were reduced very rapidly, specifically when Trump started his rhetoric against China for the global trade. And when he started the trade war, this is when we broke out. So the breakout on the upside was a full breakout. We have a breakout on the downside, which again, it's not good looking for the economy. So market activity. Do I have the detail? No, I didn't show you that. So I don't have the detail, but that's the global average activity. You see that it's still rising, not as fast as it used to over the past week, specifically the first week of April. It's still rising. What it doesn't show, because I don't show you the detail, is that positive sign is that the activity on the S&P is flattening, both actually on the volatility indicator and the volume indicator. It's also flattening on the US dollar, on the treasuries, but it's spiking on gold at this time, and the increase of this week is largely due to the increase in the activity of gold. So the market is still under tension. And again, I mean, the one thing what I like to say is that you can play the hero there, but the real heroes are all dead. That's how they finish. Another reason, I liked what I wanted to show you. This is one of the reasons that I like to look at cross-market analysis. And you have fund managers, so I don't want to say name, but you have very famous fund managers who have built their career on cross-market analysis. And this is one of them, which is simply a ratio of TLT, so long-term treasuries, versus the S&P. And why is it interesting is that anytime we have a break out of the trend, something is happening. So you had the first break of the trend on this chart, which is the middle of the chart, when you see TLT spiking versus the S&P. When was it? It was when we, at the beginning of August 2024, when everyone was fearing about the carry trade unwinding that could trigger massive implications on not only on the forex market, but the bond market as well, which is really the keystone, what holds everything, and then consequently the stock market. So we had that break here, which again signed heightened tension at this point. And if you look at more recently, so we had this trend broken at the beginning of March. Which is when the market started going down. Now the positive news for, let's say, today and for the last 2 weeks with the rebound is that the bonds are underperforming and have broken a pretty short-term trend And the bonds are underperforming versus US equities, S&P specifically here. So that's a positive sign. Again, everything has to be taken in balance. The price action itself, that kind of sign, the risk in the market, and that's what makes investing pretty difficult. So in terms of relationship, you see here that if you look at the NASDAQ or the large caps, let's say Dow Jones Industrial Average, and the small caps here, when the market rebound in sync, large caps and small caps didn't outperform the S&P. The only that outperformed the S&P is the NASDAQ. Again, money going back to the tech sector with hopes of reduction of the trade war. We'll see what happens, but it's not like the things that had been massacred before, or the things that were searched for before are coming back into favor. When the crisis started, we saw that the large caps, so let's say the top 30 from the Dow Jones Industrial Average, were looking like kind of a refuge. They were overperforming the S&P and the NASDAQ, when the small caps were very significantly hit by the trade war. Now that kind of in the market, the sentiment about this trade war is kind of easing, we don't see the small caps recovering massively. So I think that's a big deal, because it's these are the ones that will probably be more impacted by continuation of the trade war, and so we've seen some reduction in the large caps towards the tech sector, but it's not massive. So we'll have to see. Specifically this week, rise in the US equity market shows some signs of, I would say, not weakening, but it's not like a V-shaped recovery like in 2020, or some kind of V-shape, violent V-shape that we had, for instance, in 2008, for instance, 2009 at the bottom of the GFC. So this is why probably the markets are waiting for the Fed, waiting to see what they will announce. That would again that will be very interesting, because the Fed is under the microscope at this time. No surprise here in the equity market, consistent with the price action. The defensive sectors such as consumer staples, utilities, healthcare were underperforming the S&P recently, when they were overperforming during the crisis. That's natural, but that's another way to see where the sentiment is going in the market, just by looking at prices, basically. If you actually look at what the market was doing, you could say that because utilities were overperforming basically since the beginning of 2024, so you could say that the concerns about the market going up this way were increasing, and we had increase in in utilities at the end of February, beginning of March, rising significantly, and during basically the drop. So that that's another kind of way to measure the sentiment across the market. And maybe last thing, so we have markets going up. So equity markets going up and gold going down. So all the what I've shown you the weeks before about the market tanking well, versus gold, specifically whether it was equities, U.S. equities, European equities, U.S. dollar, treasuries, which meant there was really a rush towards safety, basically. And you can see this, on the S&P specifically since the beginning of 2025. It was clear all 2024, 2025 on the treasuries, on the US dollar as well. The last one that collapsed was the European stocks, but there was a part of reallocation from the US to Europe that we talk about that was part of the impact on these two. So I think we're good for today. Let's move back and yeah.